Concerns are still mounting, and it's got Wall Street taking a bit of a step back. Earlier this week, for example, Citi downgraded its outlook on U.S. equities to neutral, saying that, quote, U.S. exceptionalism is at least paused for the time being. For more, let's welcome in Dirk Viller. He is Citi Head of Macro Strategy and Asset Allocation, one of the folks behind this call to go to neutral, and in particular to go to neutral on U.S. stocks. So, Dirk, what was sort of the turning point for you? Because it felt like a lot of firms were sort of holding back and waiting to see how long is this going to last, how far is it going to go, before saying, okay, we have to change something. What for you was that catalyst?
Yeah, good question. I would say, just to clarify, we went actually neutral globally on equities already in February, mid to late February, but we kept the US as an overweight. And the main question to us was, do we have the right overweight? Or is it not just about a more shaky equity market, but also about US exceptionalism fading? And I think we got our answer on that over the last few weeks, because what happened was that the US data keeps disappointing. It's really quite soggy, even though the job cuts from Doge and so forth haven't really hit the numbers yet. I mean, our economist called the last NFP print the last strong NFP print, and it wasn't even that strong. Right, so we've seen this weaker data. At the same time, we got really quite positive news out of both Europe and out of China. And in particular in Europe, we had, of course, this really big fiscal announcement from Germany, but broader than just Germany. And that means we are upgrading, actually, our GDP numbers for Europe, for Germany. We have upgraded our forecast for China. So it seems like we're not saying the US goes into recession and we have to panic and sell everything. We are saying, you know, the US still has a little bit of a shaky period ahead, and there might be better opportunities outside of the US. That's more the call, to be honest.
And on the Europe side of that, Dirk, I'm curious, in those conversations with clients, like how, I don't want to say jumpy, but it feels like we've been waiting for years and years for there to be a reason to finally be excited about what is happening, both on the equity side and just the economic setup in Europe. So I guess, how did your view kind of evolve on that as a firm? And then what have those conversations been like with clients as you talk through that kind of thinking?
No, it's another good question. So one of the big questions that I get, so why did you upgrade China and not Europe, right? And so I would say our European equity strategy is also positive on Europe, but we decided to go for China. And I think on the European side, in the end, you have to ask yourself, eventually, will the AI story come back as a narrative driving the market or not? And if it does, it's basically about China or the US, or both, right? But it's probably not about Europe. And the reason why we called it a pause in US exceptionalism is really because we think eventually the AI story will come back. I don't think it's the right thing to bet on for the next 2 months, but you know, eventually it will come back, and then Europe will not be able to keep up its outperformance. I think the reason why people jump a bit in Europe is not just the European headlines, because there you could say, you know what, how much will the Germans really spend? I mean, by the way, the biggest expenditure increase in public investment in Germany ever was 1% of GDP, and that was when the reunification happened, and they basically inherited, you know, half a country that you had to rebuild, right? And so the numbers that are thrown out there might be a little bit exaggerated to basically make sure both Mr. Trump and Mr. Putin know they're serious. But you know, so that the market could have doubted. But the reason why the market jumped on Europe too is because it happened at the same time when the US turned a bit more soggy in data terms, right? So in a sense, if you do believe in the end it will be again more about AI, at some stage China, to our mind, is better than Europe, but Europe has also its merits during this difficult time for the US.
I want to dig in on Europe a bit because you are yourself German as well, so you have that perspective on your home country. And you sound a little bit skeptical. I mean, there's been a lot of optimism that, okay, Europe is finally changing. Europe is going into a more stimulative mode. Maybe even culturally, you're going to have a more pro-business feeling throughout the continent. Is that going too far?
I mean, I would say I've done emerging market research for a long time. The problem with speaking to locals is always they're slightly too bearish. So I take it with a pinch of salt. But I would say the government is a coalition government. Right? It will be very likely a coalition government. And so not that much can change. Actually, the coalition partners are really quite opposed in most of the important views on the economy and everything. So it's it will be a very difficult balancing act for the new chancellor once he's in place. And so I'm not that hopeful that it's really a sea change. I think, as I mentioned, if it hadn't been that the US is suffering weaker debt at the same time, the whole story, the market might not have gone for it as hard. Having said that, it is true that the numbers that were dialed up, 20% of GDP, right? I mean, it's completely unheard of in certainly for Germany, but even globally probably. It's just, I do think, yes, the actual spending will be on the smaller side. And secondly, there's a big the multiplier on defense spending is very low. Of the procurement spending, actually 80% goes straight to US corporates right now, to US defense companies, right? And then, of course, not everything is procurement, and clearly in Europe the mood has a little bit soured on buying US defense goods, so they're trying to source more domestically, but it will be difficult. Right? They have not built a defense industry, so what do you buy?
Right.
So the trade will continue to work, but probably more likely because we're still a bit concerned about the US rather than we keep raising our European numbers.
So maybe then, Dirk, I know we're bouncing around a little, but we'll finish coming back to the US and that story. And I'm curious how you've maybe tried to disaggregate the story for the economy over the last 6 months and some of what we've seen, particularly in the US labor market, that softening, how that plays into the corporate profit story, and trying to divide that with the more recent, let's say, uncertainty around the direction of policy. Are those interacting? Are those separate pieces? Are those, how do you see those resolving together, separately, so on?
Yeah, I think initially it was all about tariffs, right? That was the only topic that really mattered to the market. And we moved from the reason why we downgraded equities overall in February, by the way, was we thought we were moving from the Trump sentiment phase to the Trump delivery, meaning tariff phase, right? And but on the tariffs, it became more about uncertainty surrounding tariffs rather than the tariffs themselves, right? Which seem to be changing day by day. So it became hard to trade the tariffs. But having said that, one really important thing to take into account is the markets behaved completely opposite from 2018. In 2018, when the tariffs came, basically the countries that were tariffed underperformed and the US outperformed. This time around, the countries that are the main targets, meaning Europe, China, even Mexico and Canada, they outperformed the S&P. And one sort of narrative surrounding that, which I think is right and which our economists are telling, is that if you mostly tariff one country, meaning China in 2018, right? You probably hurt that economy, but you don't get hurt yourself all that much because in the end there are other suppliers who buy more from Mexico, and it sort of works out. If you tariff everyone, including Mexico and Canada, that are really very tightly integrated in the supply chain, you pay a bigger price yourself. And I think that's partly what's going on, right? So the tariffs are still super important for what is happening right now. April 2nd, I'm not sure whether we get a release that clarifies what exactly will happen, but certainly in the mind of the market, it's a major, major date that we have to be careful around. And but then you point out there's a labor market story which is slightly separate, right? It could be linked because maybe the trade uncertainty depresses investment, but the labor market story is somewhat separate in that that's a Dow story to a large extent. And you saw the Challenger survey last week was off the charts. And all those numbers haven't really fully hit the labor market yet. And there is a question about the multiplier, right? How many suppliers to the government get impacted for every bureaucrat that loses a job? And so
we still don't know that.
Yes,
that
exactly.
Piece. I want to ask about a date further out, or a thing that the market wants further out, which is the tax cuts, right?
Yeah.
So you have two things that could happen here. You could have a tax cut extension.
Yeah.
You could have additional tax cuts.
Yeah.
What happens if the additional tax cut? I mean, it seems like the base case is the tax cut extension is going to happen. If there aren't additional tax cuts, what does the market do?
Yeah, I mean, the reason why we didn't fall in despair and go negative equities or or call for recession or anything is partly that yes, the Trump agenda has many good parts for the market too. It's right. Just the sequencing is the opposite of 2018. Right? 2017 was tax cuts. 2018 was tariffs. Now we have tariffs first, and then the tax cuts, and the tax cuts will be smaller than they were, of course, in 2017. So it's not as big a deal. But yeah, I mean, I think the consumer will be weakened by the impact of the tariffs in some shape or form, because inflation expectations went up 40 basis points 1 year. Since the tariffs on China were put in place. So there is a negative impact, and if you can't offset that with tax cuts, then there is a weakening force in place. Again, you can debate the size, and we're coming from very strong growth. And so maybe by itself, that's not enough to push the economy into recession. We don't think we will end up in a recession. But certainly, tax cuts would be the positive part of the agenda. And if we get tariffs behind us and can focus on that, that would certainly be very helpful for the market, yes.
That's what the market's hoping for. Dirk, thank you so much. Thanks for coming in.
Of course.
Appreciate
Thank you.
it.